Ladies and gentlemen, good day and welcome to the Q4 and FY22 earnings conference call of Suryoday Small Finance Bank, hosted by DAM Capital Advisors Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Pritesh Bumb from DAM Capital Advisors Limited. Thank you, and over to you, sir.
Thank you, Rutuja. Hi, good morning, everyone. We, on behalf of DAM Capital, would like to welcome the management of Suryoday Small Finance Bank, represented by Mr. Bhaskar Babu Ramchandran, MD and CEO, along with the other senior management members of the team. We will have opening remarks from the management and then move on to the Q&A. Thank you. Over to you, sir.
Thank you, Pritesh. Good morning, everybody. On behalf of Suryoday Small Finance Bank, I extend a warm welcome to everyone to this Q4 and FY22 earnings call. I hope everybody had a chance to go through our investor presentation, which includes our strategy for making the bank stronger, resulting in higher growth going forward, along with financial performance for the quarter and year ended March 31st, 2022. The fiscal 22 began against the backdrop of COVID and its relative impact on the business. Geopolitical tensions combined with Omicron variant created a challenging economic environment this year, specifically at the beginning of the financial year. Despite a plethora of adversities, Suryoday demonstrated a resilient performance on the ground with a solid AUM growth of 20.4% and a disbursement growth of 59.2% in FY22 as against the previous year. We are pleased to share that our new-to-bank customer base has grown by a substantial 30% year-on-year, resulting in a total customer base of 19.2 lakh customers as of 31st March 2022. Our focus remains to acquire new asset customers and maintaining the existing good customers by giving them customized offers. On the industry front, RBI has recently increased the repo by 40 basis points to 4.4. This rate hike has come after 2 years, along with withdrawal of accommodative stance. We feel it's a step in the right direction given the inflationary environment and the dynamic global economy. Talking about the new initiatives in FY22, Suryoday launched Vikas and Star Loan products to our existing microfinance customer, offering an end-to-end digital product which includes repayment through digital means. The pilot was carried out successfully and it is now live for 50,000 Suryoday customers. Intent is to really scale it up in a very sustainable manner over this remaining months of FY23 and target around close to 5 lakh customers through these products. The other product offering is a small ticket fixed deposit, a minimum of 1,000 rupees to customers through customer service points. This is the first in the industry initiative, and the turnaround time for opening a deposit for even non-Suryoday Bank customers is 100 seconds flat. These products provide a seamless digital experience and save times for the customer and increase the base of the customers. Now let me throw some light on the key operational metrics of Q4 and FY22. On the disbursements front, the disbursements for FY22 stood at 3,528 crores, up by around 60% year-on-year. Subsequently, the bank disbursed 980 crores during Q4 compared to 1,056 crores in Q4 of FY21. The disbursements was a little bit muted on account of a substantial focus in terms of collections. The company employed a very cautious and calibrated approach in disbursing loans to customers throughout, emphasizing more in disbursing loans to existing customers with solid track record in spite of movement through COVID-1 and 2. The focus is on retaining microfinance customers while onboarding new customers in the micro and non-micro loan sector and expanding specifically the affordable and micro housing finance vertical. The collection efficiency is improving sequentially on the back of opening of the economy and nearing normalcy. The bank's one EMI adjusted collection efficiency stood at 87% as of 31st March compared to 84% for the month ended 31st December 2021. In March 22, overall collection efficiency touched 116% compared to 109% in December 21. The collections vertical being the most critical, we have created a special task force of 400 collection officers on a pan-India basis specifically to target the GNPA and write-off customers. Our gross advances grew by 20.4% to 5,064 crores on a year-on-year basis. At the end of March 22, inclusive finance comprises 66.9% of the asset book, while affordable home loans, commercial vehicles, and secured business loans comprise 8.8%, 6.7%, and 4.7% respectively. As a strategy, we have been increasing our non-inclusive finance portfolio gradually over the last few quarters. The mix of non-inclusive finance has risen from 27% as of September 21 to 33% as of March 22. Suryoday plans to have a portfolio mix of 45% of inclusive finance and 55% in non-inclusive finance book by FY25. On the deposits front, our total deposits witnessed a growth of 18.2% to 3,849.8 crores. Retail deposits currently comprise 78.1% and bulk deposits comprise 21.9% of the total deposits. Furthermore, 100% of our bulk deposits are non-callable in nature. CASA, which is excluding the CD, improved to 20.2% as of 31st March 22 compared to 15.4% during the previous year, resulting in a steady improvement in line with our granular retail strategy. Our borrowings as on end of March form 31.2% of our total liabilities, clearly in design with our asset liability management. On the distribution front, Suryoday is spread across 565 branches, of which 98 branches are specifically focused on deposit mobilization, while 360 branches are asset focused specifically in terms of inclusive finance business. And the balance comprises of rural centers. Through this branch network, the bank serves 19.2 lakh customers, of which total asset customers were 16.5 lakhs and total liability customers were 15.8 lakh customers. The GNPA as of 31st March stood at 11.8 compared to GNPA of 10.5 as of 31st December. The net NPA stood at 5.9. The provision coverage as of 31st March was at 69.8%. The delinquency in the portfolio increased due to the impact of multiple COVID. PAR 90 plus of the portfolio stood at 7.4%. Total standard restructured pool is currently 10.4% of our advances as of 31st March 2022. The collection efficiency on the restructured book stood at 45% as on date. We intend to increase the collection percentage to closer to 60% in the coming quarters. We continue to monitor restructured portfolio for collections. On the earnings update, on the earnings side, net interest income increased by 53% year on year to 460 crores in FY22, and net total income increased by 39.3% to 678 crores. NIM stood at 8.6% for FY22 compared to 7.1% for FY21. Other income mainly included income from sale of investments of 14.7 crores. Cost of funds reduced to 7% in FY22 compared to 8% in FY21 and 8.6% in FY20. Cost to income during the same period moderated to 60.9% as compared to 67.5% during the previous financial year, which was primarily due to rise in income coupled with lower cost of borrowings. The company incurred a loss of 93 crores in FY22. As of March 22, we continue to hold a floating provision of 91.3 crores on the books. Our capital adequacy continues to be very strong. Our capital adequacy of the bank currently is 37.9% compared to 51.2% as on FY21. Of this, Tier 1 comprises 34.4% and Tier 2 comprises 3.4% of in the capital adequacy calculations. There is a significant thrust on digital front with the technology transformation program being on track and expected to be completed by Q2 of this financial year. We have done a collaboration with Lending Card to leverage digital partnerships to provide value-added products and services to our customers. The overall digital transactions have been increasing sequentially with a rise in UPI transactions as well as on online transactions through the net banking. To summarize, the business had witnessed earlier an adverse impact due to COVID-induced lockdowns. However, we see a return to normalized scenario to pre-COVID levels. Our endeavor is to grow the loan book by 25% every year. Not just the loan book, we intend to grow our customer base by closer to 15 to 20% in this financial year. Suryoday plans to progressively increase the share of non-inclusive finance product mix from 33% currently to 50 to 55% by FY25. This increase will happen in terms of delivering secured loan products even to our existing inclusive finance customer. Suryoday targets to disburse 400 crores per month from this quarter, from the Q2 of FY23. On the deposit front, we foresee a great opportunity in leveraging our JLG customer and offer them liability products. Suryoday aims to expand its presence very cautiously in new states and focuses on strengthening its foothold in the existing states. Going forward, the company will target closer to 40 crores of PPOP on a monthly basis from Q2 FY23 onwards, along with maintaining a GNPA below around 8%. This is from our end in terms of update. Look forward to our interactions. Thank you, Pritesh.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ashutosh Adsare from SBI General Insurance. Please go ahead.
Hello, am I audible?
Yes, Mr. Ashutosh.
Yeah. Hi, sir. Sir, firstly on the disbursement front, you said the Q4 there was muted due to focus on collection. So going forward, in the earlier interaction, you had guided for 30-35% loan growth in FY23, and now you are saying loan growth of 25%. So do you mean that your focus will shift on collection and hence disbursement will get impacted going forward for FY23?
Not really, Ashutosh. What we had guided earlier is around 30 to 35%. We continue to kind of hold that range. 25 to 35 is our guidance. But on a lower end, it will be likely to be not less than 25. But at the current pickup of business, as you really see it, including our own kind of liabilities, which are substantially in surplus, we are kind of aiming towards more of a 30% growth for this financial year.
Okay.
And that growth will be predicated both in terms of not just the loan book. Even last year, we exhibited a very robust growth of closer to 30%, which is actually higher than the growth in the books, gross advances in terms of customer acquisition. So the higher customer acquisition done in the previous year will reflect robustly and substantially in terms of increased disbursements during FY23 as
well. Okay. And sir, on the collection efficiency, if you could throw some light, you said on the restructured book, your efficiency stands at 45% and you're targeting at 60%. So how you intend to increase this and how the book in the restructured has been performing currently?
Yeah, as we kind of mentioned, it is 45%. Why we said 60% is not just an increase in a mathematical number. It is, we have put in a collection force of 400 dedicated only in terms of collections. The team's job, the executive job in the collection team is to only get in touch with the customers who are restructured, and even within that, the customers who are already NPA and the write-off customers. We have seen a very good traction in the last 2 months in terms of the focused collection effort. And the reason why it's really accelerating is that the customers, many customers, even though they're not paid for a sequential 4 to 5 months, the moment the touch point increases, we have seen kind of accounts getting activated with as low as an amount of around 500 rupees and then slowly moving towards one EMI. Earlier, our intent was to really activate the customer in terms of getting them into payment mode. And as we kind of stabilizing, we're looking at in terms of taking in a collection of minimum of one EMI, and we are fairly seeing a good traction on that front. And based on that, we are looking at activating at least another additional 15% and hence closer to 60% of the restructured portfolio.
Okay. And on the standard book, you had mentioned that 60% of the customers were paying and the GNPA book. So on the standard book, if you could throw some light on that.
Hi, good morning. So insofar as the standard book is concerned, it reflects the full normalization. Our PAR in the standard book is less than 3%, and we will continue to focus on bettering that number and keeping it as low. Our focus entirely is on the restructured book and thereof the non-paying part to ensure collectability and pullback of the GNPA.
Okay. And on the cost to income ratio from FY21, you've significantly managed to cut down your cost from 67 to 60%. So going forward, how much scope do you think it's left, or it will remain at this elevated level in the cost to income side?
Yeah, so a lot of this has been possible because of the growth in our pre-provision operating profit, which has grown by about 70%. As guided previously, for the current year, we would be targeting a 55% cost income ratio, while our steady state long-term goal will be to go back to the 50% levels where we were pre-COVID.
Okay. And in terms of provisions, you maintain your guidance of 200 crores of provisions for FY23?
Yes, given the kind of growth in book that we have and the overall collection efforts that we have in mind, what we had advised is that we will look to have about 100 crore of final cleanup in Q1 of this year and a total provisioning target of around 150 to 200 crores, and we stick to that guidance.
Okay. Last question from my side. In the PAR 90 segment, on a sequential basis, there has been an increase from 4.6 to 7.4. So, do you think you'll be able to cut back this PAR 90 level to your erstwhile run rate of 3.4%?
Yeah, I mean, that's the specific the challenge that we have taken upon ourselves, and Bhaskar talked about this dedicated team of collection agents that we have put in place. This increase in PAR is largely due to the restructured part of the book, and that's what is the primary focus of our collection efforts.
Okay. That's it from my side. If you have any further questions, I'll come back to you. Thank you.
Sure. Yeah.
Thank you. Participants who wishes to ask a question may press star and 1. The next question is from the line of Nandan Madhiwala from Punctuous One Capital. Please go ahead.
Hi, thanks for taking my question. I think in the Q3 presentation we had mentioned that by Q1 we are looking to bring down GNPA to around 8% or so. Does that continue to hold, or you think it'll take some more time?
The intent in terms of putting up the collection force is precisely that, Mr. Madhivanan. What we kind of know, whatever slippages has happened, as kind of Coach Casey mentioned, was in terms of restructured advances, and we have not done any restructuring with a long moratorium. There were a couple of months and then kind of moved into some of them have slipped, as you said, the collection efficiency is at 45%. Sub 8% is our target, and I think for the way we are building up the momentum, clearly that is where it is. So maybe it may change by a couple of months, but clearly that's the intent in terms of reducing it to 8%.
Okay, and just on the Q1, I think we had mentioned that elevated provisions would continue till Q1, so that still remains, right? You don't see provisions going up beyond Q1.
That's right.
Yes, please. That's
what we have done is that in the last 2 years, we have not increased the ticket sizes beyond what we are kind of we're comfortable with, including for our existing good customers. So that's where you will see a very moderated, low principal outstanding per customer. So one of the ways in which obviously the GNPA can run is a bit higher base, including higher funding to the existing customers. We have been very prudent and will continue to be prudent. And what we are kind of clearly seeing is a portfolio built which is approximately closer to 2,000 crores in the inclusive finance portfolio post July 21 continues to be near 99% in terms of collection. So we will continue to be very prudent in terms of building, increasing the loan ticket sizes even to our existing customers. And our focus will be in terms of building a customer base increase as well. While the growth of the entire advances was only 20, we had a growth in terms of customer base of 30%. So the increase in customer base of the last year will reflect in terms of very robust disbursement. And to that extent, the base impact itself will reduce the GNPA marginally. But our intent is at an absolute level itself, we want to reduce the GNPA amount.
And just one last question. I think in the last call we had mentioned that from July 2022 onwards, we are looking at a monthly PPOP of 40 crores. Is that correct? And does that still hold?
Yes.
Okay. All right. Thanks. That's it. All the best.
Thank you very much.
Thank you. Ladies and gentlemen, you ask a question, you may press star and 1 now. The next question is from the line of Varun Ghia from Dimensional Securities. Please go ahead.
Hello.
I'm sorry to interrupt you, Mr. Varun, but there is a disturbance from your line.
Hello. Can you hear me?
Yes, Varun.
Yeah. So, could you explain why the yields were lower? Was there any interest reversal, or is this due to some other reason?
Hi, good morning, Varun. These are principally on account of some excess interest capitalization reversed. These related to restructurings done in September. So on a full year basis, there is no impact, but on a quarter-on-quarter basis, there will be a bit of a distortion.
How much was the reversal for full year?
It was about 25 crores or so adjustment.
Okay.
Quarter. Yeah.
And going forward, what yields do you target?
So on a gross book basis, we will continue to target around 18% given the mix. As indicated by Bhaskar, our focus is to grow the secured lending book, which will have a comparatively lower yield as compared to the inclusive finance book. So 17 to 18% range is what we would be comfortable at, and that's the corridor we will work in.
Got it. Thank you.
Thank you. Ladies and gentlemen, to ask a question, you may press star and 1 now. The next question is from the line of Pritesh Bumb from DAM Capital Advisors. Please go ahead.
Hi, sir, a couple of questions. You said that you will be limiting moving to newer geographies and focus on the geographies which you are in. Can you give some, or you can share some areas where you don't feel that or penetration in newer geographies is done, or is that the penetration in the existing geographies where you are in is very less and you want to focus on the same? And how will you increase the customer base from those kind of areas? Yeah, that's the first question.
Sure. So we don't have a deep penetration in many of the states where we entered, and some of the states where we have actually been present for long. One of the states is Karnataka. We've been present for closer to around 8 years, but our penetration is very, very marginal. So our intent is to really focus deep into Karnataka. The other couple of states where we have recently entered in the last couple of years, and again, very low penetration, is the states of Rajasthan and Uttar Pradesh. So the intent is to really penetrate a little more into these markets before really expanding into the other new geographies. In inclusive finance, we are kind of watching out in terms of some of the states which are getting highly penetrated, where we may not even have a presence. But consciously, in the past, we have stayed away, and currently also even in the present, wherever we see, even when the markets are performing very well, like the state of Bihar, but we see a huge increase in the portfolio base, we tend to kind of defer our plans in terms of looking at those markets. So we are not looking at some of those markets which on performances are extremely good, where our presence is nil, but we will kind of not really look at entering those markets for inclusive finance for now. In terms of the rest of the other products, our penetration even in terms of our existing branches is very low, like affordable home loan or commercial vehicle will operate at no more than 30% of our existing branch network at this point of time. For those products, the delivery would be in terms of increasing our presence. For instance, our commercial vehicle presence or an affordable home loan presence in very key states like Karnataka and Tamil Nadu is very, very low. So intent is to really put the business force there and increase it rather than geographically expanding at this point of time for our size of business.
Sure. Second part of that question was, at what cycle will you start increasing the ticket size in the FI book? You said that right now you're not increasing any ticket size. So at what cycle of the customer life cycle do we want to increase the ticket sizes?
Yeah. So what's happening now is we are not clearly going by only the cycles and increasing it. The customers have multiple footprints in terms of even retail asset exposures. So closer to around 28,000 of our customers in inclusive finance have an average home loan taken of around 6.5 lakhs on disbursement and 5 lakhs in terms of principal outstanding and are current in those loans. And there are around 4.5 lakh of our customers in the overall customer base who have an excellent track record in retail assets. So analytics comes into play in terms of understanding the profile of the customer apart from the primary data we gather from the customers. And we are shifting to a mode where not necessarily only by the number of cycles they were with us, we are going to increase the size, or probably will not increase the size just because the customer has been with us for 3 or 4 cycles with an excellent track record. So we'll use all of that, and to the extent where the customer can handle the EMIs, and there is a clear business requirement for taking a loan of size of around 1.5 lakh, we are will certainly look into it, which is our digital offerings will be all about. And for the rest of the customers, we'll moderate it out currently at around, which is the first cycle is around closer to around 35,000. We'll retain around the same range. And the max we are comfortable whether it is cycle 2 or 3. If we don't have any other substantive data that they can handle a higher loan, would be closer to 60,000, 75,000 at max.
Sure. And just wanted to check, are we in line with the RBI guidelines in terms of household debt, and are we having things in place to know what is the household debt in terms of the software or whatever the market insights are required on that?
We had invested post-COVID counterintuitively in terms of heavy investment in analytics. So even before any of the new norms came in place, we had a full visibility in terms of the customer and the guarantor in terms of their composite outstandings and their monthly EMI obligation. So given that perspective we had, what we are kind of doing is more in terms of getting the income data of the entire household. Earlier it was restricted only to the borrower, the household and the guarantor, which 95% of the times happen to be the spouse of the borrower. So today we'll have to also gather data in terms of unmarried children. So that's an extra piece that we have built in, and which will kind of go fully automated end of this month. And as of now, we are collecting it through our own mechanism of Kaisala.
Sure. And another question was on collection efficiency that seems to be lower compared to peers in most of the segments like MFI or even CV. Even if you look at some of our peers like Credit Access has done well on collection efficiency in Karnataka. What seems to be issue for us, and why is the collection efficiency still lower when people have almost reached about 99%, including on NPA or arrears basis? So what is the issue with us?
I will not be able to comment in terms of the competitors' data or performance, but what we kind of measure ourselves is in terms of one EMI, that is for the EMI generated for the month, how much of EMI is paid. And it includes all the customers where the EMI is generated, whether they are a write-off customer, except for the write-off, whether it is a GNPA customer, whether they are customers with the moratorium with respect to all the EMIs that are generated. Against that, we kind of measure. So the one data which kind of gives us a qualitative outlook in terms of where we stand is that the book built after July 21, which is around 2,000 crore to the inclusive finance book, is at 99% in terms of 98.5% in terms of collections. And with the one which we are kind of working out in terms of getting back on track is the pre-COVID portfolio. So we kind of one of the recognition in terms of a collection or repairing it is to understand the problem. So we haven't resisted from funding any customer who are in overdue even with us, even for a 60-day. We have not done any of those fundings that try to activate. The models can be very, very different. So to that extent, we recognize as it is. And a couple of the NPA stamping is also on account of we had given a small OD product at that point of time. And even if the customer is regular in the regular loans and then the OD she has not serviced the small interest for a period of 3 months, we still get tagged as an NPA. So to that extent, that may be not be necessarily comparable. But our one EMI computed has been marginally going up and currently at 86. As the new portfolio builds up, we clearly see that inching more towards 90% and above by probably end of this quarter.
Okay, thank you, sir. I'll come back in the queue if I have more questions. Thank you so much.
Thank you. The next question is from the line of Rini Singhal from LOK Capital. Please go ahead.
Hi, thank you. Hi, Master. So couple of questions. One, out of all the non-JLG products, which is the product where we are seeing most traction, good unit economics, and we are bullish on, and we are looking to grow it maximum in the next financial year?
We are looking at affordable home loan and the secure business loan backed by property as a key driver. We have built a small but a very robust used vehicle finance portfolio in the last 1 year on strong underwriting, and that portfolio is kind of collections is very close to 100%, and 30 plus itself is sub 3%. So intent is to can we really build a very strong used vehicle portfolio, but less than around 5% in terms of 30 plus and probably around 2% in terms of 90 plus. So that will kind of keep adding, but it will not add substantially to the overall volume at this point of time. But the key driver in terms of value would be mortgages, which is both home loans, affordable home loan, as well as in terms of secured business loan. Our current cost of borrowing, including the excess liquidity which we carry over around 1,000 crores, is at 7%. As the interest rate cycle is kicking up, we clearly kind of see a very competitive advantage in terms of playing that mid segment, which is currently priced anywhere between around 11 to 14%. Would be our growth driver for this year and for years to come.
Okay, thanks, sir. Second question, in terms of just the yields within the JLG segment, given the new guidelines for the MFIs, I know that this is not applicable to us, but are we seeing some sort of at least reversal of yield compression that was happening in the last 2 years? Have we taken some interest rate hikes in the JLG segment?
Yeah, the yield, as of now, it has not come down. In fact, probably in the market post this, there would have been an increase in pricing to cover up the credit losses and so on. We are continuing to maintain the same pricing, which we are kind of having either before the repo rate hike or before the new unified norms came into picture. Our intent over the long term is to convert the customers to repaying us also through the digital means and use analytics and offer both products in terms of disbursement as well as in terms of collections back digitally. And that should lead to a substantial drop in operating costs, which we intend to kind of pass it back to the customer. And ideally, a good inclusive finance model at the current cost structure would be beneficial both to the institution and to the customer, at least well paying with a good track record, should be priced closer to probably around 18 to 19%. So that convergence is what will happen as things become more digital and customers become more aware and start paying even without a touch point being in place for every installment. So that's where we have launched 2 of the products. One is called Vikas loan, where you are around closer to 50,000 customers. Another loan is a Star loan, which is a pre-approved product for our existing customer based on all scrub data done, except for income capturing at the field level. If these 2 products were to really scale, we believe that the operating cost will kind of dramatically come down, probably not immediately, but in the next 3 or 4 quarters.
Okay, thank you. And one very last, more of a clarificatory question. The GNPA percent of 11.8 on slide 22 versus the PAR 90 of 7.4%. So what's the delta between the two?
Yeah, so as Bhaskar explained, that's largely on account of customers to whom we would have offered our Smile OD product, right? So they would be current on their principal loan, which is a term loan, but at a customer level, they would have been tagged as NPA because their payment would have been irregular on the OD.
It's also possible that there's another one, which is a customer touches 90, they get stamped as GNPA for banks. And even if the customer starts paying one installment thereafter and stays in the bucket of 30 for a moment, it will still be considered as a GNPA till the entire amount is repaid and they become regular all over again. And in the microfinance segment, when the customer slips to any particular bucket, while they continue, good customers continue to make one installment or 2 installments, clearing up all 3 installments built up generally is a challenge, which gets done only towards the end of the tenor. So that would be the difference between the divergence between our 7.4 and 11% plus.
Thanks a lot, sir.
Thank you. Before we take the next question, reminder to the participants, anyone who wishes to ask a question may press star and 1. The next question is from the line of Aman Mehta from Haitong Securities. Please go ahead. Mr. Aman Mehta, please go ahead with your question. Your line is unmuted. Mr. Aman Mehta, may we request you to unmute yourself if muted from your handset?
Okay.
Hello?
Am I audible?
Yes, sir, you
Hello?
are. Please go ahead.
Thank you, sir, for giving this opportunity. Can you help me with the breakup of restructured book and the total provision on it?
Yeah. So our total restructured book as of today stands at 700 crores out of the 5,663 crore book that we have, right?
How much of that is standard?
Yeah. And if you are looking at in terms of the standard part of the restructured book, so the standard part of the restructured book is around 10%.
Okay. And about in standard restructured book, there are various segments, JLG, CV, HL. Can you provide data for that?
In terms of the
Predominantly it will be JLG segment, and the rest of the segment will be very, very small.
Okay. Thank you, sir.
Around 550 crores of our 550 plus 50, around 600 crores happens to be from JLG, 100 crores of which 65 crores happens to be from CV, and around 12 crores happens to be from HL.
Okay. Thank you, sir.
Thank you. Reminder to the participants, anyone who wishes to ask a question may press star and 1. The next question is from the line of Pritesh Bam from DAM Capital Advisors. Please go ahead.
Sir, just wanted to check on the scenario in the market now after the RBI rate hikes. What will be our stance on the deposit side in terms of rates? And will we be able to pass on some of the rates on the non-MFI portfolio? You explained on the MFI side, but do you think that we can pass on some of the rates if deposit rates have to be hiked? And what is the stance on the deposit side?
So insofar as our home loan and LAP portfolio is concerned, a significant portion of that portfolio is, is variable linked, and it's linked to the repo. So to that extent, yes, there will be some amount of transmission in the rates, especially as the new disbursements take place and as the old disbursements come out of the first 3 years of fixed rates.
Very, very marginal in terms of a bottom line, Vitesh. So even on a 1,000 crore portfolio, which is a 40 pips, is around closer to around 4 crores. So on a comparable overall number, it may not be a significant mover of the needle.
The CV portfolio also will be linked to repo rate?
No, that's a fixed rate product.
Yeah, I think that is the second largest segment, I think, in our loan book. So what can be, I mean, of course, as you said, it's not a very significant thing, but as you go ahead and build a little bit of the portfolio which is on CV as well, along with affordable housing, do you see any risk to pass on yields there over time on the new loans as well?
That won't be the case, at least at this particular point in time, because most of our borrowings are multi-year with rates locked in. So to that extent, for the time being, we are fairly comfortable. We are also sitting on excess liquidity that will help us in terms of rate management. As I said, home loan LAP is the segment that we are focusing on, and we will grow it significantly. And in that particular portfolio, we certainly will have a variable rate product.
Fair. And the questions on rates on deposits, I mean, can we conclude that you're not going to change any of the rates immediately as you have excess liquidity?
Yes, broadly yes. And already we are at a particular spot, which is a 3-year deposit, we are offering 7, so which happens to be as competitive. So we'll kind of hold on to our deposit rate at this point of time.
Fair enough. Thank you so much, sir.
Thank you. Ladies and gentlemen, as this was the last question for today, I would now like to hand the conference over to the management for closing comments.
Thank you. So as stated last quarter, we continue to kind of maintain that the growth would be in the range of around 30% and little upwards. While our guidance is anywhere between 25 to 35, we intend at the current growth pace, it will be closer to 30. Equally driven by the increase in customer acquisition, even when across the industry we see a flat or marginal negative growth in terms of customer base, specifically in inclusive. As our engine in terms of the non-inclusive finance product have stabilized, specifically in the last 1 year, we intend to grow home loans as mentioned by Kanishka, as well as in terms of secured business loan far more robustly, and specifically in terms of our excess liquidity which we have maintained all along, and currently our cost of funds being at around close to 7%. We will diversify the portfolio in a very meaningful manner. We don't intend to kind of increase the ticket size in terms of inclusive finance substantially without clear backing in terms of analytics data of the household economic status. And we do believe that FY23 will be a year of enterprise profit. And Q4, as we guided, we are kind of endeavoring to deliver a 40 crores PPOP starting from Q2, and we'll stay focused on it. intent is to reduce the GNPA by 8%, and we are fairly confident that we will be closer to that number by end of Q1. With this, we intend that swinging back into sustained profitability, and with that we built in terms of managing the portfolio in a right mix. We will not be doing that by reducing the growth in terms of the inclusive finance, but the growth in terms of the other products will be much higher, considering that they are at a small base at this point of time. In terms of overall other key things in terms of our borrowings, in terms of our asset liability matching, in terms of governance, we continue to be pretty strong, including capital adequacy. And we believe that that will come into a big use in a very volatile year like what we are probably entering in terms of FY23. Look forward. Thank you very much for your cooperation.
Thank you. On behalf of DAM Capital Advisors Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.